post-Bitcoin, having bigger miners accumulate more BTC, CryptoQuant. Tanzeel Akhtar last updated July 30th, 2024 at 11:17 GMT3, 2 minutes read. Since the Bitcoin halving event, a noticeable trend has emerged within the mining community. Smaller miners are selling their Bitcoin holdings, while larger publicly traded mining companies are accumulating more Bitcoin. According to Julio Moreno, head of research at CryptoQuant, this shift reflects the differing strategies and financial capabilities between small-scale and large-scale miners. In the aftermath of the halving, Bitcoin halving, an event that occurs approximately every 4 years, reduces the reward for mining new blocks by half. The most recent halving was on April 19th. The halving saw miners' rewards drop from 6.025 BTC to 3.125 BTC. This reduction in rewards increases the operational pressure on miners, particularly affecting those with less efficient operations or higher costs. Bitcoin mining has become as cost-intensive as ever since the halving, with the asset's hash price at its lowest levels ever over the past 2 months, according to hash rate index data. Smaller miners under pressure to sell. Smaller miners, often operating with thinner profit margins and less advanced mining equipment, find themselves under more immediate financial pressure. Post-halving, the reduced income from mining means they must sell their Bitcoin to cover operational costs and remain viable. This necessity to liquidate holdings makes them more vulnerable to market fluctuations and operational challenges. In contrast, larger, publicly traded mining companies have demonstrated a capacity to not only maintain but also grow their Bitcoin reserves. Reports from major players in the industry reveal that these companies are strategically accumulating Bitcoin. Some have even gone a step further, purchasing additional Bitcoin from the market to bolster their reserves. This approach is due to more access to capital, more efficient mining operations, and often lower electricity costs due to bulk agreements or ownership of renewable energy sources. Marathon, Riot are considered large mining firms. Large mining firms such as Marathon Digital Holdings and Riot Platform have reported higher reserves, aligning with their strategy to hold on to Bitcoin as a long-term investment, anticipating future price increases. Their financial robustness allows them to weather the reduced mining rewards and position themselves advantageously for future market conditions. With smaller miners continuing to sell and larger miners accumulating, this trend is likely to influence market supply dynamics and the competitive landscape of the Bitcoin mining industry. Earlier this month, Marathon Digital announced the purchase of $100 million worth of Bitcoin in the open market. The company said it would revisit its HODL strategy and commit to keeping all mined Bitcoin on its balance sheet. Follow us on Google News.